We'll now look at the new tick charts functionality, which without a doubt is the most important addition in this release of SD Zones. It will let you find setups which you never could have found before, and quality setups, I should add. I bet you're thinking that was a long opening act to get to the start of the show, but really I had to. High time frame link, the revamped workspace layout, and the streamlined trade finding, those were all necessary for the tick-based workflow to come together. Let's open the workspace and you'll see. As you can see, I still have the black Futures Swing workspace open from earlier, and that's deliberate because I want to stress the importance of keeping the number of open SD Radar workspaces to a minimum, particularly demanding ones, and none are more demanding than the new Ticks workspace. So let's close this one. And you already know what's going to happen, I think, when I do this. We get, as I discussed earlier, this warning from TradeStation, who wants to point out that you are about to close a workspace that has automation features enabled, namely this high time frame link over here. No big deal, just click close. Also, as usual, it asks whether you want to save this workspace, which I don't in this case, but you certainly can. All right. And let's open the Ticks workspace. File, open workspace. We were in the Futures Legacy Layout folder. Remember we were looking at the Excel Swing workspace earlier, this one down here. So we'll go up one level into the High Time Frame Link Layout folder. Boy, that's a great name. And in here we have the Futures Ticks, and that's the one we want. And you know what's going to happen now in a little bit when it's loaded a little more first. I think you know. There it comes. The warning from TradeStation say you're about to open a workspace that has automation features enabled. Do you want that? The question is yes, you want that. You want them with enabled. You could open it with them disabled and you'll be disappointed that none of the stuff works. So we'll just open them with Windows enabled. Or open the Windows with the items enabled. There it comes. The high time frame chart with high time frame link enabled. We already had all the other entry charts, and I don't know if you noticed, but it took a little while to populate this this radar screen. If this is the first time you are opening the Ticks workspace, or if you haven't opened it in a while, it will take some time to open. If this is a very busy time of the day, such as right around the opening hour, or actually right around the market open, it will take a very long time to download these because TradeStation is so busy, and we're looking at downloading millions and millions and millions and millions of ticks. So so do be aware that this is a workspace that definitely will keep TradeStation on its toes and keep it busy. So you want to be a little bit prepared. Open it a few minutes before you need to work on it. Obviously, if you load it every day or even several times a day, it'll be much quicker because everything will be in the cache. All right, so here she is, and I hope you're not disappointed. She looks almost exactly like her siblings. We have a larger entry chart here. We have 5 smaller entry charts over here. We have a high time frame chart here, which obviously is linked with a high time frame link to the entry chart. We have another high time frame chart down here, which, different from the other ones, is actually now a 60-minute. I'll explain why in a little bit. And then obviously we have the radar screen. The big difference you'll notice in radar screen here is that, yes, we have the usual symbols, except I've taken out the 10-year and the 30-year bonds, which really are not that suited for tick charts or for tick trading. But the main thing you'll notice is these intervals vary with each symbol, right? This is a big deal. So we're not looking at 3 minutes, 5 minutes. We would not look at that. We're looking at 5 different intervals for each, and the intervals vary with each symbol. All right, what's that about? First of all, if you have not yet had a chance to watch that share bars and tick charts crash course that is already on the SD Zones membership page, I really recommend that you do so. Let me just show it again. I showed it in the introduction, but let me just show it again. This is the SD Zones membership page, and if you scroll down to the training videos, You'll see these are the latest trading videos from earlier this year, from May this year. And if you scroll down to number 6 there, that one says volume and tick charts crash course, and that really gives the introduction to to what they are, how they work, and how and why they are valid for trading supply and demand. All right, so just want to point that out. I will introduce it real briefly now, but not as elaborately as I do in that lesson there. In classic time-based charts, such as this 5-minute oil chart, every bar represents a number of minutes and the open, high, low, close of any trades that took place in that period. So if we zoom in, I know you're familiar with this, but if you zoom in, this is a closing bar that closed at 5 p.m. Last Friday, and the open, high, low, close is displayed right there. And it doesn't matter how much trading is taking place. It's just whatever trades, even if it's just one trade that took place in that time period of that particular bar. During slow periods, such as overnight, bars will paint as if all is normal, even though very little actual trading took place. And you've seen that before. This is what it looks like. In the case of oil, starting around 3 o'clock Eastern time, when the trading pits in oil closed back in the days, up until the Europeans get going around 3 o'clock, this is what it looks like. Look at these. Very little trading. 37 contracts traded overall. Very little activity. Zones that may form during such periods are often just random noise rather than true institutional accumulation or distribution. Surprisingly, many zones formed during those periods still do work, but they are still lower probability than zones formed during times with high institutional participation, as we start getting out here. So that we can find it again, I'm going to mark this low volume period with a rectangle so we can easily see where it was. It's right around here. It's not that important where it is. So this area here. With tick charts, each bar represents a number of trades rather than a number of minutes. And the number of trades in each bar is specified by the interval. Let's change this 5-minute oil chart to a 600 tick oil chart. So 600 trades in each bar. I could do that very easily by just typing 600 ticks like this. And there we go. As a result, bars only paint when a minimum amount of trading took place, squeezing out the empty calories, the noise bars, during low volume periods. Notice how this 12-hour period was suddenly condensed to really just a few bars here. This leads to fewer zones formed during doldrum periods, but the ones that do form are generally more reliable compared to low volume minute-based charts such as 2, 3, or 5 minutes. TradeStation has another type of chart which I like even better, being volume charts, also called share bars. In these charts, each bar represents a number of contracts or a number of shares traded rather than a number of trades. I can change it like this. Let's type 600 shares instead. You may notice that the chart didn't change all that much. It is very different still from the 5-minute chart, but not that different from the 600 tick chart. I always liked volume charts with supply and demand, since they guarantee a certain volume during the formation of a zone, making it more reliable to represent genuine accumulation or distribution. But unfortunately, volume intervals don't work in radar screen, meaning I'd have to manually go through hundreds of charts each day to find where the good trade candidates are, and usually miss the best. That is why I developed SD zones back in the days. But it turns out that tick charts are a good enough approximation of volume charts. Consider this volume chart, where every bar traded almost exactly 600 contracts, as we would expect. If we go back to the 600 tick chart, you may expect that volume would vary much more dramatically because obviously each trade would have to be different sizes. And lo and behold, that is not the case. Volume here is surprisingly even, right around 700 contracts for each bar. The few peaks above the 700 that we see are usually around news events or when the market is opening or closing. In research I performed last year in all 18 markets I trade, I found that 80 to 90% of trades are just one contract. I did not expect that, but that is what I found. That means tick charts are a good enough proxy for volume charts. And tick charts do work in radar screen. The next challenge then becomes determining what is an appropriate tick interval for each market, since obviously they have different volume and they even vary dramatically during the day. I want to point out that there are no magic or perfect intervals in supply and demand trading. Every interval, whether minute charts or tick charts, is just one view. It's one zoom level looking at all the grains of sand on a beach, each grain being a trade. But the interval needs to reflect the trading activity in a given asset. The 600 ticks I used here with oil is too high for platinum, but is too low for the ES. The tick intervals you see in radar screen on the ticks workspace, they are based on the daily average volume of each market over the last 12 months. The base interval, that is the top symbol row of each of the markets, is 1/1000th of the daily volume, or if you will, 0.1%. The other intervals are then 2 times, 3 times, 4 times, and 5 times the base interval. So, in the case of the ES, it has an average 1.5 million shares or contracts traded every day, leading to a base interval of 1500 ticks. The other intervals will then be 3000, 4500, 6000, and 7500, and so forth with all of the other ones. So yes, I went through that exercise with every single market to arrive at these, and I'm updating these about every 6 months as volume in each of these change. This doesn't make these intervals more right or wrong than any other interval. It's just that they are in a reasonable range for each asset. You can add other markets you trade and determine intervals the same way. Again, the crash course in the May 2025 training video shows you how to find the average volume of each asset on a daily chart and how to arrive at these intervals.